So we're looking at P5-34A, and they give me an unadjusted trial balance for this company called Thomas Electronics. Okay? And what does it say here? Journalize the adjusting entries using the following data. Interest revenue accrued. Okay, so when you think about that, if you're accruing interest revenue, you're going to have interest receivable, because that means you haven't collected it yet. Okay, so you're going to have interest receivable of 250, and then you're going to record the revenue. So we're going to increase revenue, specifically interest revenue, by 250. Okay, so that'll be the entry to accrue interest revenue. All right, makes sense. So you got a receivable, which is an asset, and then you have more revenue. It's just that it's in a different category of revenue called interest revenue. Okay? Salaries. So we're going to accrue salaries. So specifically in the selling department. So selling salaries accrued 3,300. Salaries are an expense. So I'm going to book salaries expense. I'm going to be careful. I'm going to book salaries expense selling. And then what do you guys think it's going to be called? Well, we haven't paid for it yet, so it's going to be salaries payable. That's a liability. So that's going to be my, to accrue salaries expense. So far, so good.
What does accrue mean?
Accrue.
Accrue.
You're capturing more of it.
Oh, okay.
Yeah, you're capturing more. You're actually getting it on your books when it needs to be on your books. So since those salaries pertain to the year that's completed, we need to get those that salaries expense into that year. So we're booking it, or into this month, March, right? We're getting it into March. If we wait until we pay it, it's not really an expense pertaining to the date that we pay it on, because we're going to pay it after March, so that expense would end up in April, when it's really a cost that belongs in March.
Oh, so you're like separating it.
We're capturing it into March. Okay. Here's depreciation expense. So remember, when we do depreciation expense, we book the expense. That's an increase to the expense, a debit of 1,300, and then we don't reduce the asset directly. We make that book into an account called accumulated depreciation, which is a contra asset account. Okay, so this is to record depreciation on equipment. All right. Let's see what else we got. Now we have an interest expense. So the first one was an interest receivable, which is interest revenue. On the interest expense side, remember, expenses increase with debits. So I'm going to book a $1,200 debit to interest expense, and then because we haven't paid it yet, it's going to be called interest payable. That's a liability. So you have an expense and a liability being recorded, and we're accruing interest expense. We're putting that expense into the proper time frame. We're putting that expense into March, even though we're probably not going to pay it till later. It's going to be put into March. Okay, it says a physical count of inventory was completed. The ending merchandise inventory should have a balance of 45,000. Okay, so let's look at what we do have. Where is our inventory? Merchandise inventory 45,600. Okay, so it should have a balance of 45,000. So there's a $600 difference, right? So what are we going to do? You know, we'll go ahead and try this. $600. You know, we might want to put this into an expense. Do they have a special expense for inventory shrinkage?
I think you're right, it is cost of goods sold.
Or they're putting it right into cost of goods sold, okay.
I think so.
Sometimes there might be another account that we can use. Okay. So far so good, yeah? Now we have to take what we did here into consideration when we prepare the adjusted trial balance, right? So I think they give you a little blue link here that will let you see the journal entries that you did above there. Okay. So you did 5 of them, A through E. You have to take the effect of these journal entries and apply them to these balances, right? Before you come up with your adjusted trial balance. So it probably would look more like this, right? You got your unadjusted trial balance, then you would apply these journal entries. So for instance, let's just take one here. We'll take one balance. Interest receivable, right? Interest receivable started out with a zero balance, right? But we made this debit to interest receivable, so we're gonna now have $250 in interest receivable. You see what I'm doing? So I'm taking the unadjusted amounts and applying the effect of these journal entries to those unadjusted amounts. So some of these things will make them go up and some of these things will make them go down. Okay, and it's not affecting every single account. If you notice here, we never touched cash, right? In these adjustments, cash was never touched. So we can put our original cash balance in, right? So it doesn't give you a whole bunch of room to work with, but what might help is to list the accounts. So we might want to just list the accounts to start off with. So I'll go cash, I'll go accounts receivable, I'll go interest receivable. Make sure you pick the right ones because some of them have the same first word in their title, but the second word is different. Merchandise inventory. I got office supplies. I've got equipment. I've got the accumulated depreciation on the equipment. I've got accounts payable. I've got salaries payable. Interest payable. Unearned revenue. Let's see what else we got. Notes payable long term. We got common stock. Retained earnings. We got dividends, sales revenue, we got sales returns and allowances, sales discounts, interest revenue, we got cost of goods sold. What else do we have? Salaries expense. Selling, right? Rent expense selling. And we go to administrative, so we got salaries expense administrative and rent expense. No rent expense for administrative. Utilities expense administrative. Depreciation expense. And then interest expense. Okay. And then we have to go down the list, right? So what you want to do is you want to make sure you're thinking about these journal entries when you make those new balances in those accounts. So I can tell you by looking at this, there was no effect on cash. So my cash balance will come over the same, right? Now accounts receivable, there was an effect. So scan these entries here and kind of get an idea. Actually, no effect on accounts receivable. So I can bring accounts receivable over at 38,700. Interest receivable, I do have an effect, right? And I would scan down because we might have had something happen twice to it, but no, just once. Interest receivable went up by 250, debit of 250. It's showing a 0 here, so 0 plus 250 is 250. Okay. What happened to inventory? Did anything happen to inventory? Very last entry. Inventory decreased by 600. Okay. So I will look at my inventory, 45,600. If it got credited for 600, you see here, credited 600, that means that this debit balance of 45,600 has to go down by 600. So you're left with 45,000 in inventory. Okay. Office supplies, did we have any entry to office supplies? None. So office supplies will come over at their current balance of 6,600. Okay. Equipment. I don't see anything in my adjusting entries that affected equipment. So equipment of 130,000 will be pulled over. Okay. Now, accumulated depreciation on equipment. I can recall in my head there was something that went on with that. And over here on March 31st, item C, we had a credit of 1,300 to accumulated depreciation on equipment. So 1,300. That account is sitting there with a $37,700 balance. So we're actually adding 1,300 to that. Okay. So that's going to give me 39,000. Be careful, that's a credit balance. And if you want to double check, you can always use your calculator. 37,700 plus 1,300 is 39. Okay. Accounts payable. Did we do anything with accounts payable? We had salaries payable, interest payable, but no accounts payable. So accounts payable will come over at its balance of 16,200. Make sure you put it in the credit column because it has a credit balance. Okay. Salaries payable. Okay. Looks like we did do something with salaries payable. There was a credit of 3,300. Let's check out what the original balance was. Salaries payable had 0, so we're just adding 3,300 to it. Okay. What about interest payable? Okay, it starts with 0. We had the item D, there was a $1,200 credit to interest payable, so that's the new balance, 1,200. Okay. Unearned revenue, we didn't make any entry to unearned revenue, so we'll go down here and we'll take that unearned revenue balance of 13,900 and pull it over. Notes payable long term, nothing to do with notes payable long term in the adjusting entries, so I can pull that balance over 46,000. Common stock, no adjusting entries made to common stock, so I can pull the common stock balance over 35,000. Retained earnings, nothing was done to retained earnings, 23,700. Dividends, no entry to dividends, so 20,000. Sales revenue, let's see. Started with 300,000. Nothing done to sales revenue, so we can pull that 300,000 over. Sales returns and allowances, I don't see anything with that, so I'll pull that over. 700. Sales discounts. Interest revenue. Okay, here we have some interest revenue. 250 credit to interest revenue. What did we start with over here? Interest revenue. 0. Okay. So it's kind of a special case where a lot of these adjustments are being made to accounts that have a unadjusted balance of 0. But keep in mind, if there was a number in there, you're either going to have to add or subtract that adjustment to it to get your correct number, your adjusted number. Okay. Let's see, cost of goods sold. We did make an adjustment. Notice, we increased cost of goods sold with a debit of 600. What is cost of goods sold's balance? 165,000. So the new balance is going to be 165,600. We're going to tack on another 600. Okay. Salaries expense selling. Let's see. Okay, we made a debit of 3,300 to salaries expense selling. What was it to start? 23,000. So we're going to have 26,300. I'm adding that debit. Okay. Rent expense selling. We didn't do anything with rent expense. So I can pull the number over from the unadjusted trial balance. Salaries expense administrative. Nothing there. Utilities expense administrative. We didn't do anything with utilities. Okay. Depreciation expense. We did something. 1,300. It has a 0 balance to start, so it goes up by 1,300. And interest expense has a 0 balance. We did do something to interest expense, 1,200 debit. So that's going to be 1,200 debit. Okay. Now we're not done. But to make sure we did this right, so I got to add up all of my debits and add up all of my credits, and they need to balance. If they don't balance, then I'm gonna have to go back and figure out where it is that I did something wrong. So let's start with my debits. So I'm starting with cash and adding downwards. Oh. Anyway, I gotta do it again. Let's go from now. I'm gonna add as far as I can see. I'm going upwards this time. And I'll put that into memory. And then I'll scroll up and add the second half of the debits. Okay? And then we'll add that. Okay, I got 478,550. Now the credits will be easier because there's fewer of them. And I think we can see them all without having to scroll. Yeah. So they go from accumulated depreciation down to interest revenue. Why don't we add them? 39,000. And then what we do is we hope I mean, maybe we're accurate enough where we don't have to hope, but we want to make sure they balance. And it looks like I got an equal amount of credit and debit. I would not hit enter at this point if my credits and debits did not equal. So we'll hit enter. And we got a fantastic. Okay. So now we have an adjusted trial balance. And we can use that adjusted trial balance, which they regenerate for you here, so you can have it side by side. We can take this adjusted trial balance to make our income statement. Okay? So if I had a ruler and I could draw a line, I could draw a line after dividends here, straight across. Does it give me a ruler? No line, okay. And everything below that line, just have an imaginary line here. Everything below that line would pertain to my income statement. Okay? So everything from sales revenue down. So I'm going to put my sales revenue in first. And my sales revenue is 300,000. This looks like a multi-step income statement. So what we're going to do is we're going to subtract any sales returns and allowances and any sales discounts. So that's what this less is for here. We'll go less sales returns and allowances and less sales discounts. Okay? And we'll get those two. What are they? 7,000 and 1,000. Okay, so if I got 300,000 and I'm subtracting 8,000, I'll have 292,000. Right, 292,000. That's going to be what we call our net sales. It's your sales net of the sales returns and allowances and sales discounts. Okay, and I think we're okay not showing these as negative since the word less here qualifies what they are. The less is telling us to subtract them from the 300. Okay. Now what do I subtract? You guys remember? In a multi-step income statement, the next thing I subtract is my cost of goods sold. Right? So I'll come over here and find cost of goods sold, 165,600. Okay, so I'm going to subtract 165,600 from my net sales. And that will give me, you remember what I call it? Gross profit, right? We call that gross profit. Okay. Now we're going to have our operating expenses. And we're going to have two categories. We're going to have administrative and we're going to have selling. You know, this thing kind of gives you a little bit of a cheat here because you got 2 items in one category and you got 3 items in the other. So we got to make sure we put if we only have 2 selling items, then we're going to put the selling items first. But if we only have 2 administrative items, we'll put the administrative items first. So let's just see. Get that calculator out of the way. We've got to look at our expenses, right? So for salaries, I got selling. Looks like I have 3 administrative expenses. So that's going to be the second category here, administrative expenses. Okay. And then the first category is going to be my selling expenses. Okay. And then from there we can list the expenses that go into each of those buckets per se. Okay. So selling, I got salaries, right? Salaries and rent. Okay. So salaries, expense selling, and rent expense. You get my eyeball straight here. Selling. And we'll drop those numbers in. I got 26,300 and I got rent of 15,400. Okay. So if we add the two, we're going to have 41,700. Oops. 41,700. You can double check that. That's going to be my total selling expenses. Now we do the administrative expenses. We got three of them. I might do them in the order that they would go. Utilities, administrative, and that's 10,200. I got depreciation expense, administrative. That's 1,300. And then I have interest expense. No, I'm sorry. Salaries expense, administrative. Okay. And that's 5,600. Okay. Then you just add them up. So whether you do it in your head faster or with a calculator, it's up to you. That would be my total administrative expenses. Okay. So if I take my total selling expenses and add them to my total administrative expenses, that will give me my total operating expenses. Because we're in the operating expense category. Okay. So we can do that. I'll go 41,700 plus 17,100. Right? Just taking the two subtotals. And that gives me 58,800. So far, so good. Okay. So we're doing a multi-step income statement. There's multiple steps involved. Now I need to subtract my operating expenses, my total operating expenses, from my gross profit, and that'll give me my operating income. Okay, so I'm going to take 126,400 subtract 58,800. That gives me 67,600.
Are you subtracting that from your gross profit?
Yes, because you need to subtract expenses, right? Expenses are subtracted. Okay. Revenues increase our income, and expenses decrease our income. So on the income statement, we're going to always be subtracting expenses. Okay. And cost of goods sold is an expense, so keep that in mind. Okay. Now we're going to have a category called other revenues and expenses, or other revenue and expenses, and that's where your interests will go, either whether it's an interest revenue or interest expense. So we got to come back up here and look. We got interest revenue of 250. So I'll put that in as a positive. Interest revenue. And then I have interest expense of 1,200. I'm going to make that negative. Just because the header here, the title for that category, and we got the title wrong. I put the total in, but it's really other revenue and expenses. They show the expenses in parentheses. Okay. So we're going to have 950 negative, right? And that would be my total other revenue and expenses. We'll double check that, make sure we're right. Yeah. And then what we do is, since it's a net expense amount, we have to subtract that. Since this is net negative, we're going to subtract it. So 67,600, which is our total operating income, minus 950. And that's going to give me a net income of 66,650. Then you come over here and check answer. Right? Okay? So just like from chapter 1, right? We got to go through the process of making each financial statement. So we're going to take our beginning retained earnings, which is sitting here on our adjusted trial balance. And the reason I know that this is the beginning retained earnings is because if it was the ending retained earnings, we wouldn't be showing any dividends, revenues, or expenses. Those accounts would have been closed to retained earnings. Okay, so all of this stuff hasn't taken an effect. All of this stuff down below retained earnings hasn't taken effect on that retained earnings balance. So that 23,700 is the beginning balance. Okay. Then what do? We add net income, right? Remember? Net income for the year, 66,000. We just figured it out, right? 66,650 from the income statement right up here, right? Okay. So if we add the two, we're going to get a subtotal. And our subtotal is 90,350. Then we're going to take the dividend amount of 20,000 and subtract that. So dividends of 20,000 will be subtracted. So we end up with 70,350. The beginning retained earnings was sitting right here on the trial balance, on the adjusted trial balance. Yeah? Now we will make a balance sheet. Okay, so your balance sheet's going to be starting with your assets. We got current assets. So your current assets would be anything that's cash or convertible to cash within a year. So it would be everything up through office supplies. Okay, equipment is a long-term asset. So we'll start with cash. We got accounts receivable. We got interest receivable. We got merchandise inventory. And then we have office supplies. Okay? And I'll drop those numbers in and add them up to make a subtotal. So this is called a classified balance sheet because you have classes of things, right? We have current assets as one class. Property, plant, and equipment would be another class. It's not just listing all of the assets and all of the liabilities. We're categorizing them. And then we can add those up to get our total current assets. Okay, so my total current assets are 94,950. Total current assets. Okay. Then I'm going to do my property, plant, and equipment, sometimes called plant assets. So my plant assets will be my equipment and the related accumulated depreciation. So I think we had a question on this one the other day, right? How do you show it on the balance sheet? Well, this is how we do it. We show the equipment at cost. So I got $130,000 in equipment to be shown at cost. And then I'm going to show it net of my accumulated depreciation. So you have to say less accumulated depreciation on the equipment, and you'll plug that in, 39,000. So the net equipment amount will be 130,000 minus the accumulated depreciation of 39,000. So 91,000. We'll call that my total plant assets. Okay? So if I add my total current assets to my total plant assets, I will have my total assets. Okay? So we're going to call that total assets. Okay? We'll have 185,950. Looks like it to me. We'll take a chance. This time I won't use a calculator. Got it. Okay. So sometimes good to try out your mental math. If you want to add in your head that way. Total assets 185,950. Now we're going to do the liability section. So we're going to start here right after accumulated depreciation. You got your accounts payable. So we're going to do our current liabilities. And that would be everything that's going to be paid off within a year. okay, are taken care of within a year. So that includes unearned revenue. So it's going to be these 4 items: accounts payable, salaries payable, interest payable, and unearned revenue. So we'll go accounts payable, we'll go salaries payable, we'll go interest payable, and unearned revenue. Okay, and then we drop those numbers in. So I got 16,200 for accounts payable, 3,300 for salaries payable, interest payable is 1,200, and unearned revenue is 13,900. Okay, you're pretty good if you could add those up in your head that way. I'm going to use my calculator if I can get a hold of it here. Okay, so 16,200. And that would give me my total current liabilities. Total current liabilities are 34,600. Total current liabilities. Now we're going to do long-term liabilities. Different category, different class, but they're still liabilities. So we're going to make a category here for long-term liabilities. And we'll look at our trial balance. What are my long-term liabilities? Well, it'll be my notes payable. That's the only one we have. So 46,000 in long-term notes payable. Okay, 46,000. So total liabilities will be a combination of my current liabilities and my long-term liabilities. Okay, so 80,600. Wait, 7. Yes. Looks like it, right? I think so. Okay. Now we'll do equity. Equity is made up of 2 things. Common stock, for now, 2 things. Okay, and retained earnings. We've got to get my retained earnings in there. We can't call it salaries expense. Okay. So if we look up our common stock over here, common stock is 35,000 on my trial balance. We'll put a 35,000 in over here. Now this is where we could make a mistake, right? Remember, we're going to pull the retained earnings from the retained earnings statement, not from this trial balance, because this is not our ending retained earnings. The reason we know that is because we still have all of these other things below it, dividends, sales revenue, and expenses, that through closing entries get rolled up into retained earnings. So these things are not, they're not rolled up into retained earnings yet. That cannot be my ending retained earnings balance. I'm going to go back to my retained earnings statement, and I'm going to pull that ending retained earnings figure of 70,350. That's my ending retained earnings, 70,350. If you put in the one from the trial balance, your balance sheet is not going to balance. Okay? If your balance sheet doesn't balance, do not hit submit. That's a double mistake, right? 1, your balance sheet didn't balance, and 2, you hit submit when you knew it didn't balance, right? The balance sheet has to balance. So we got to use the ending retained earnings figure, and that comes from the retained earnings statement. Okay? Let's see now. I got to make a subtotal. All right. So my total equity is a 105,350. Adding these 2. Okay, so that's my total stockholders' equity. Now remember, this is the second side of the balance sheet, and the second side of the balance sheet is a combination of your liabilities and your equity, and that combination should equal your total assets. So what we need to do is we need to add total liabilities of 80,600 to total stockholders' equity of 105,350. So if I kind of do that in my head, that's going to be 185,950, 185,950. And what you want to do is you want to come back up here and look at your total assets. Is that the same number? Yes. Okay. Looks like we're in balance. We're about to make one more mistake. We didn't label that last line. So that's called your total liabilities and stockholders' equity. Okay. Nice work. That's the end of that one, right? Why don't we